Hey, thanks, Ryan. Hello, and welcome everyone to our live event tonight. I think it's going to be a very educational evening as we are going to cover how to analyze a fund using AAII tools. My name is Derek Hageman. I'm a financial analyst at AAII and editor of AAII's dividend investing service, and I'll be serving as tonight's moderator. It is my pleasure to introduce tonight's speaker, Charles. Whoa, wait a second. You don't look like Charles. I don't see a bow tie, which we all know is Charles' signature look. Stepping in for Charles tonight is AAII President John Bajkowski. How are you doing tonight, John?
Very good. Thank you very much for the introduction, and I'm sorry that Charles couldn't make it here. I guess something happened over the past weekend.
Yeah, I mean, thanks for stepping in tonight. I understand that Charles had an incident over the last day or two. Do you know if Charles is all right, and do you know what happened to him?
Well, all I know is I think it involved doing the limbo and breaking his arm. So Charles managed to break his arm and is awaiting to do some surgery to get it fixed. So in the meantime, we're all helping in to step in and take over some of his responsibilities. And I offer to host tonight's presentation.
Well, definitely thanks for stepping in for Charles tonight, John. And I'm going to be keeping an eye out for questions. So please go ahead and type your questions into the questions panel. John will be answering these questions throughout the presentation. So John, we look forward to your presentation. And with that, please take it away.
Well, thank you. Yeah, and hopefully I have a lifeline or two. So if I get stumped by any question, I'll either reach out to Charles or I'll phone a friend somewhere else. So good evening and welcome. And our goal tonight is to look at the resources that you have as a member when it comes to selecting some mutual funds, as well as analyzing the types of funds that are out there. And so we're going to go through the resources that we have on our website, and primarily really the website, because over the years we've grown from offering a lot of books and information that's covered in our magazine as far as mutual funds are concerned, and focusing more on the tools that we have more on a more current basis as far as the site is concerned. So when it comes to mutual funds, we're going to talk about really two types of mutual funds tonight. We're going to talk about open-ended mutual funds, a traditional fund that you buy directly from the fund family. You buy and sell at the net asset value that's set by every day. And we cover, using Morningstar as our data source for our mutual fund information, we're covering over 24,000 funds in our online data set. These are basically all the funds that are available to you either directly. These are in some cases sold to individual investors. In some cases, they're part of pension plans. In some cases, they're loaded funds that are sold by advisors. And we'll talk about some ways you can filter that down so that if you're doing your own research, it only makes sense to go ahead and invest in usually no load funds. Because why bother paying a load if you don't have to, if you're doing your own work and research? The other type of fund that's become popular over the last few years is the ETF, exchange traded funds. In this case, the funds may or may not trade at their NAV, the net asset value, which is the value of all the assets divided by the shares outstanding. They're probably pretty close to it. They actually trade on exchanges, so you buy and sell them from your broker. But now that most brokers have no commissions and you can even buy fractional shares, it's very easy and inexpensive now to buy ETFs. Traditionally, open-ended funds were actively managed. They cover many categories. But nowadays, again, index funds are really the primary domain of exchange-traded funds. But now we have a mix of both index funds for ETFs and open-ended funds, and in some cases, active funds are available on ETFs as well. So in terms of our universe of funds that we have on our website, it's all open-ended funds, 24,000, and all publicly traded ETFs that you have access to. As far as information, so we get it from Morningstar, we update it monthly, and we cover all the basic things you'd want to take a look at. When it comes to analyzing and picking a mutual fund, you're looking at it typically on a longer term basis. Really, stocks, you need to get company information, you probably want price information, and you want to do some assessment as to what it's worth. With ETFs, really it's a function of return, and we'll talk about what you want to compare the return to. And so we have returns that cover both short-term and long-term periods. Also, how importantly, how that return compares to other funds in the same category. Expense ratios, how much costs do these funds typically have as far as you as an owner of them, how they allocate their assets, as the allocation, asset, a lot of domestic, foreign, stocks, bonds, volatility, the risk of that information, we calculate that in there, how to contact the fund, portfolio turnover rates. So these are all information. We get that from Morningstar. We process it for you. And we also, in some cases, we've created some grades, and we'll talk about that a little later on. But we also use grades then to help indicate how a fund is doing against its peer group. Is it doing well, and we'll give it an A grade, or is it doing poorly? In that case, we'd give it an F grade. And when it comes to getting stock ideas, strike that, mutual fund ideas. When it comes to getting mutual fund ideas, here are some good resources. You're probably going to stop me there on that, how Derek got me using the word stocks.
Yeah, I just want to, as we go along, definitely just want to, as people have questions, jump in. So there was a question you mentioned on the earlier slide about the Morningstar categories and a lot of this information coming from Morningstar. So there was a question about how much do we rely on Morningstar for our analysis.
Well, really, when it comes to all the raw data that we get, it is all Morningstar based. When I first started at the association, 30 years ago, you would go ahead and contact the funds ourselves, and we'd calculate the rates of return, and we'd produce all the information. But since then, it became really more efficient just to go to a trusted source such as Morningstar to get all the return information, get the category breakdowns, get the asset allocation information. So in that case, for the most part, really we're getting it from Morningstar as far as the information. In some cases, we do some custom processing. So when it comes to grading the funds themselves, we'll grade them using our own methodologies, calculating things like the risk index. If we calculate a bull and bear period, we'll do that on our own. But for the most part, the raw data is coming to us from Morningstar. And so the Morningstar data comes to us, we process it, we update it every month. And on our website, then we have some good information that's available for you. And really, the things we'll touch upon that's available are things like top and bottom performing lists of consistent performing funds. Even as a manager, especially if you're tracking an actively traded fund, actively managed fund, perhaps you want to take a look at manager changes and what are performance benchmarks. And then also, if you want to compare your fund on a risk-adjusted basis, especially if it's an equity fund, we have tools that help you do that. So when it comes to getting fund information, if you go to our website, these are tools that are available to you as a member. All you have to do is log in. So you want to make sure you can log into our website. And if you click on investing ideas, there are two main sub-tabs or navigation areas that come up. One for mutual funds, we have things like mutual fund ideas, which is the main mutual fund landing page, ETF ideas, which is the main ETF landing page, and the ability to compare funds or ETFs, look at what's opened and closed, consistent performers, things like that. This is how you'd access that as a member on our website. And one of the things that I always kind of find interesting is looking at top and bottom performing funds. And in this case, we're looking at over the last 5 years, these are the best and worst performing overall U.S. equity funds. And the trick is always, if you just look at raw rates of return, how what funds did well, which funds did poorly, without looking at some kind of context, you may just be chasing last year's winners, which often go on to be next year's losers. So one has to be very careful at just looking at best and worst performing funds. I can't stress this enough. It's important when looking at best performing funds, or top or bottom, that you really compare it against funds in the same category. Otherwise, you'll just simply be chasing funds and going back into the mean for inversion. But if you go to our website and you click on top, bottom performing funds, you can look at funds based upon their major asset category, U.S. equity, international funds, sector funds, fixed income. You can specify the ones that are either for the last year, 3 years, 5 years, or 10 years. And you can then go ahead and look at the top 100 or bottom performing funds for both the funds as well as on the ETFs. Now, when you click on that, you could also, when you get to say the open-ended funds, with 24,000 funds, if you start sorting it very quickly, you'll find that a lot of funds in there aren't really meaningful or are perhaps loaded funds. So you can, within that subgroup, look at all of the funds. You can specify, just show me the no load funds. And also, you can even go as far as to specify, I want to look at just funds within a specific fund family. So I can go ahead and select under fund family, just look at the Vanguard funds. I want to see how all the Vanguard funds have performed. In this case, I have the sector funds, and they're probably sorted based upon the 1-year rate of return. And you can see in this case, some of the top funds that how they performed last year, 276%. That's the other thing to consider. And we've just hit the 12-month mark, the 1-year mark of our market bottom. I mean, last year, tough to believe, if we were doing the same webinar in April of 2020, we'd be coming off a market bottom. The market would have been, fallen 30%, and we would a lot of uncertainty going forward. And basically, the market has shot up since then. But if you look at a 1-year rate of return for mutual funds, it's going to show tremendous rates of return, 200%, 140%. Those aren't really predictive of what you see in a typical year. So you have to be careful when you look at how that 1-year performance comes in. So anytime you do short-term performance, is that one past year predictive of what you might expect into the future? And when it comes to ETFs as well, again, here's a situation where looking at the last 3 years, and we have ETFs here, how they've performed, and you could control this information. And again, as a member, you have access to this data. So more important beyond simply looking at what the top and bottom performing funds are is being able to do comparisons of your own funds. So on the fund element, one of the things to make note of is that as a member, you can set up a portfolio. And in that portfolio, you could enter in stocks, open-ended funds, and ETFs. And in that context, whenever you have any funds or ETFs, and there's some relevant information to analyze it, like in this case, there are 4 funds that are entered into a portfolio that have been saved on our website. It'll go ahead and allow you to analyze how those 4 funds compare and take a look at their risk-adjusted rate of return relative to the market. And you can see whether or not they've done better or worse on a risk-adjusted basis. So it's a helpful comparison to basically equate what the market's done. So in this case, Fidelity OTC is 15% more risky than that of the market, but its rate of return is still much more higher than the market. So even though it's higher risk, you've been compensated by taking on that risk and actually getting a rate of return that you'd expect more than you would for just having a 15% more volatility than the stock market is concerned. So this is a very helpful tool, and there's information to analyze how this particular calculation is computed. So you can click on this adjusted link here. It'll take you to how that information is calculated. Consistent performers is where I really start to look at, and I think one of the better tools that we have. But before we do that, let's perhaps have a question from Derek.
Yeah, if you don't mind, just have a couple that are coming across. There was one from P. Shaw. He asked, he commented, I'm aware of the differences between mutual funds and ETFs, but it is not clear why AAII has separate databases for mutual funds and ETFs. There are many times where there are equivalent investments in either mutual fund and ETF form, and maintaining separate databases makes it more difficult to do comparisons. Do you have anything you could add to that or comment on why they are separate?
Well, they're separate as far as searching, because typically speaking, some of the constraints are different as far as how one would go ahead and buy them. And, typically speaking, with the mutual fund, open-ended fund, you'd be buying it directly from the fund family. Now, when it comes to comparing them, we actually have a comparison tool in which you can mix and match ETFs and open-ended funds. So if you are trying to pick one versus the other, in fact, we'll show that towards the end of our presentation, there is a comparison tool that allows you to select both. So you bring up a valid point. When it comes to even ETFs, ETFs beyond having a NAV return have a price return? So there are some complexities to each that kind of require some separate analysis, but obviously within a given category. And we'll touch upon this a little bit in a moment, but really what we recommend doing is first figuring out what asset allocation is appropriate for you, and you can use the wealth building process to help do that. But you want to figure out what's your asset allocation. And I'm not sure, Derek, maybe you're like me, do you have all of your assets in stocks or funds, or do you mix things up?
I mix things up.
Yeah, I'm the same way. And what I do is I have a desired asset allocation, and so I have I have a large cap segment, and in that case I'm actually using funds, ETFs to fulfill that part. But then I have some stocks in my small cap segment, so I have some individual stock holdings there, and I've got some tech stocks as well. So I'm not sure, what I do is I figure out what my asset allocation is going to be, how I'm going to fulfill that allocation. It might be funds, it might be ETFs, and then I try to find what's appropriate for me. So when it comes to picking out funds, the same thing. You first want to start out with your asset allocation. So in this case, if you just look at consistent performers, in this case, the consistent performers are sorted by the worst 10-year rate of return here. And okay, so this is going to tell me that a fund such as the gold double long fund is perhaps the best performer in its category. But do I want to be in the trading leveraged commodities area? Probably not. So I probably want to, when it comes to looking at things like consistent performers, I probably first want to pick what sector I want to be, what industry I want to be in, or what segment I want to be in, and then find which funds within that category are the best performers. And I'm guessing you do the same thing, Derek.
That's exactly. I think we're drinking the same Kool-Aid. Have a very similar process. I may be more heavily weighted towards dividend-paying stocks because obviously that's where my enjoyment lies.
Well, and you actually find you're able. I mean, one of the things is always, we want to teach is play to your competitive advantage. And what Derek's a bargain hunter. And I mean, no, seriously. I mean, that's we joke around about it.
That's the politest term you've called it.
Well, you're a bargain hunter. I've never called you the junk man. But I mean, you like looking at things like dividend yield to identify stocks that are attractive, that you're basically buying a high quality company at an above average yield and getting a rate of return from that. So using some competitive advantage that you've established to buy your stocks, and you're willing to take the time and effort to manage that stock portfolio. If you're just getting started, you don't want to bother managing a stock portfolio, you simply want to do a buy it and forget it thing, then funds might be your starting point, and you could just over time expand upon your knowledge and build up some equity positions. But you might have some questions for me, Derek. Sorry.
Yep, they're definitely coming in fast and furious. Let's see. Let's go to Thomas asked, are the 5-year average returns after fees?
Typically speaking, when it comes to mutual funds, they are after things like expense ratios. They are not load adjusted. So the expense ratio, 12B1 charges, those are after those costs are incurred by the fund, but they are not load adjusted. So in the case of a mutual fund, again, if you're doing your own research, one of the first things you do is just select no load and not worry about that element. But other kinds of expenses, expense ratios and whatnot are taken into account.
Okay, and then there was a specific question about where Wayne asked, where do I find recent manager changes?
So what you want to do to get that information, if you go back to this drop-down menu, if you just click on mutual fund ideas, and right here you should have, if you click on that page, it opens up a whole information on mutual funds, and same thing for ETFs. Within that page, one of the sections is the mutual fund manager changes that have occurred over the last, I believe it's month or so. But that is available to you as far as fund changes. If you go to investing ideas and click on mutual fund ideas or ETF ideas, or if you go to any of these links, either funds or ETFs, it'll take you to what kind of manager changes have occurred recently. So with that, again, we really preach, and I think it's important to look at category performance within your approach. And we talked about it briefly, and Charles is in here, but one of the things that he's really been working on very much in the last year is what we're calling individual investor wealth building process. And it's a 5-step program, a 5-step process where first You define your goals, then you pick your appropriate asset allocation. You identify how much of it do you want to invest, via perhaps a money manager, on your own, through stocks, through funds. You select your investments and you monitor, and you kind of rinse and repeat. So the wealth building process has a lot of information. It has, in fact, 12 different challenges to help you along this road towards determining where you want to go and how to get there. One of the things it has is this appropriate asset allocation thing. So we've spent some time trying to figure out what are some basic kinds of models to use. These are some 3 different models if you're aggressive, moderate, or conservative. And there's some techniques to help figure that out, where you are in your stage of life, how much money you have, how much time do you have before you're going to actually need your money to pull it out, and how much risk can you tolerate. So these are suggested asset allocations, and they kind of serve as a starting point. So again, start off with an asset allocation. As an investor, you don't really need to go much beyond here. You can, of course, use a robo-investor. You can use a fee-based advisor, but really, for most people, a basic asset allocation, either aggressive, moderate, or conservative, is going to be all you really need to kind of plan out your future and meet your long-term goals. And one of the things that we do also online, so if you click at that wealth building process, these are the funds that we use to track the performance. And so we've selected some low cost index funds to help track those types of averages. These could be a starting point. So if you are invested in general large cap stock thing, you might want to compare how your fund's doing against the Vanguard 500 Admiral class shares and see how its expense ratios compare, how its performance compares. If it's not any better, perhaps you should consider using that kind of fund. And as a member, one of the other benefits that you have access to is both a mutual fund guide and an ETF guide. Now, again, when I started at the association 30 years ago, we printed the book annually. It was, in fact, it'd come out midsummer because it took us so long to get the information that was true to the end of the year as far as rates of return, contact the funds, get all the information updated, printed, and sent out to you. But nowadays, with the online era that we're on, you have access to new information, all the mutual funds, all the ETFs, updated every month. You can look at it based upon the different major categories. You can look at also subcategories. And it's again, if you go to this URL, it's available to you. Same thing with the mutual fund ETF guide. Information is updated every month. You can download an Excel spreadsheet. You can also hit a compare to button. So remember that when we talk about the compare to feature in a moment. And you could also, if you want to, if you find a fund that you find interesting or ETF you will find interesting, you can go ahead and add it to a portfolio that you should store. And again, a portfolio, it can be simply a watch list, it can be something your own, but it could be just a quick way for you to track funds, stocks, ETFs over time and do some comparative analysis to you. But as a member, you have access to this information updated every month on our website. And this is one benefit, though, that I guess is a little bit extra. It's the mutual fund screener and the ETF screener. Up till now, everything we've talked about is available to you as a member of the association. These are tools that require an A+ investor subscription, but they allow you to basically go ahead and determine your own criteria if you want to filter down the universe of funds to a smaller set. Derek, I'm ready for you.
All right, great. A couple questions. We had one from Zoe asking, can you briefly explain the difference between ETFs and a mutual fund?
Yeah, well, they're both professionally managed funds, and they both have objectives as far as a goal to meet a certain financial objective using certain kinds of instruments. The difference is that a open-ended mutual fund, the shares are sold directly to you, and you redeem the shares you buy directly to the fund family. And what happens is every day, the fund determines how much its assets are worth and determines how much they're worth on a per share basis. So if you want to go ahead and invest in that fund, you send them the money or you tell your broker to go ahead and invest in that. Let's say I want to invest $5,000. They'll take your $5,000 and basically sell you the assets for what the overall value, average value of the assets are on the fund that day. And so they basically price the fund once a day, and you buy and then you redeem also at the once a day value. So when you want to redeem money, they have to provide liquidity, and they have to basically within 7 days give you your money. So you're dealing directly with the fund. Now, there may be an intermediary such as a broker, but you're basically buying and selling assets, redeeming and purchasing assets directly from the fund, other fund investors. With an exchange traded fund, you are not dealing with a fund directly. You're dealing with other investors who own shares that are roughly equal, that are equivalent to what the NAV is. Sometimes they trade at a slight discount or premium from the NAV, but the price is set, and there's arbitrage that takes place to try to keep that price as close to the value of the underlying assets as possible. And so when you come and buy and sell, you're not dealing with the fund family manager directly. You're buying and selling from other individuals on an exchange. And you can do it over the course of the day.
Excellent, excellent. Couple more here for you. Andrew is asking, is there a query box for funds that are still open for investors, just to avoid ones that are closed?
If you are using the fund screener, I know for sure you can go ahead and indicate if it's open or closed to investors. And it's only an issue, obviously, if we're open to mutual funds. I have to check to see if it's available on the fund guide itself. If not, it's obviously a good feature to add in there.
And then one more. Elliot is asking, if we look at a fund grade, how specific is the comparison group? He's asking, for example, would the grade be just for like U.S. equity, U.S. large, or mid, or small cap, or growth or value? Is it graded within its category from Morningstar?
Yeah, we'll talk about it in more greater depth down in a moment. But basically, when we are grading a fund, we're grading it specifically against the same narrow category in which it's located. So, for example, there's almost 3 layers of funds when it comes to a broad categorization of funds. You might have overall asset allocation sections, equity versus bonds, and then within there you might have domestic versus foreign. And then you have very specifically perhaps large cap value. So when we grade a fund, we're grading it against all other large cap value funds. And if it's a small cap value, same thing. If it's a sector fund, we're grading it against all the other funds in the same sector. So we're really trying to do as much as possible an apples to apples comparison.
Excellent, thanks, John.
Pleasure. So the fund screener is a tool that's available to A+ investor subscribers. It's the only tool we're discussing here tonight that does require a little bit of an extra subscription. When it comes to screening, and you can access those screening tool by clicking on ETF screener or mutual fund screener from the screening tab as opposed to the investing ideas tab. So using the fund grades, we had a question about the fund grades a moment ago. So what we do is we take, for any given period of time, any kind of information, we take all the funds that have data for that particular category, for that particular data item. Let's say it's a 1-year rate of return. We rank them from highest to lowest, and we take the funds that are in the top 20%, give them an A. We then take the next 20%, give them a B, then a C, then a D, and then an F. Now, if you've been a member for a long time, we used to actually use different terms. We used to use average, above average, and high. So high, our old high is the A, and we used to use average, below average, and low. And in this case, low is the F. So it's breakdowns of basically 20% bands when it comes to rates of return or risk grades or expense ratios. A's are always the best, F's are always the worst. So, in the case of a category risk, it's the funds that have the lowest volatility get the A grade within their category. The funds that are the highest, most volatile funds get the F grade. And expense ratios, same thing. The funds that have the lowest expense ratios within their category, and for funds and for ETFs, we break those up as well. They get the A grades. The funds that have the highest expense ratios within the category, or the ETFs that have the highest expense ratios in the category, they happen to get the F grades. That's how grades are determined, specifically within their category. And we talked about the compare tool. So one of the tools you could use as a member and it pops up in many different ways. You can compare specifically, and here's an example. We have two actively traded open-ended funds, Fidelity Magellan and the T. Rowe Price Large Cap Growth Investors Fund. And in the middle, we have a spider fund, in this case, an ETF, which is simply the S&P 500 index. And in this case, they happen to be different categories, but you can go ahead and compare how these three different funds are doing. And you could compare, and this list goes down, not only return information, expense information, inception dates, volatility. So you can go ahead and track how they compare against other funds. All you have to do is simply type in this case, comma separated funds, and it comes back with the rate of return, how the grade is for that category, and this little yellow sign here next to a fund ticker. You see that throughout our website. Anytime you see that, if you click on that, it gives you the option of adding that stock or that fund or that ETF into a portfolio. It could be a portfolio you already have. You can create a new portfolio, a new watch list if you want to track that fund going forward. So you'll see that in many spots. If I go back, for example, to the screener, you have a grade thing here, little plus sign next to a ticker. Compare is to put it into a comparison grid. The plus next to a ticker is to add it to a portfolio. That's true of the ETF guide as well. If you're looking at the ETF guide or the fund guide, the compare button brings up the comparison tool. The plus next to the ticker puts it into a portfolio or a watch list. So I find that a very handy way to go ahead and have that information in one particular swoop. Now, the key is to, when you look at performance and why it's so important to not look at performance across categories. I mean, it's interesting, and we have the ability to look at that information on our website, but it's really so critical to actually go ahead and compare how a fund does within this category. And because that's going to drive everything. It's a precious metal fund. To say it did well in 2020 is you have to compare it against other precious metal funds. And so any fund that we have 24,000 funds, 2,500 ETFs, we have Evaluator tools that you can access as a member. And again, all members have access to this information. It's updated every month. And in there you have information about its overall broad asset allocation, its more smaller allocation group. In this case, it's allocation fund, and the category is a target date fund. So everything about the T. Rowe Price 2040 fund is compared against other target date funds in roughly that same age band. And so you know that it's a apples to apples comparison. It gives you the NAV. If you were to buy this fund on April 14th, that would be the price you'd buy it at, or that's how much you'd get redemption on your return value. Minimum initial, the expense ratio, in this case, it's about average. Looks like a grade of C. How much assets are in there, whether the fund is open to new investors or not. If it has a 12B1 charge, its current dividend yield, its load, and its turnover. About 16% of this fund turnovers annually. And its rate of return information is here. It tells you how the fund compares. 1 month return is a 2.1, that's a D, below average for its category. But some of its longer information, its 5-year rate of return at 13.6 is in the top 20% of all funds. And its risk is a little bit more volatile than most funds in its category. This information is available for all funds, all ETFs. And if you wanted to follow this fund, this little plus yellow sign would let you add it to a portfolio. And then again, information as far as volatility. So when it comes to things like standard deviation and the risk. So we said this fund is a little bit above average risk. It's in the 75th percentile rank as far as risk, which is why it gets a D. It's beta, it's more risky than the market as a whole. But it tends to follow the market pretty closely. So interesting, it has a high R squared. Most of the predictive value of the volatility and the performance of this particular fund is explained by that of the S&P 500. And so information like this is available on our site for members. And ETF, same thing. And the same kind of information that's available for funds is available for ETFs. So in this case, we have again, information about this happens to be, I did a screen on top performing funds within a category. And this came up here as the iShares Russell Top 200 Growth ETF Fund. And it's a large growth category, equity, US equity. It has about 3.5 million in assets. It does actually pay a yield, pays about a 0.7% yield, and it's 52-week high-low range. Its expense ratio at 0.2 is lower than average for its group within large cap growth, and its portfolio turnover, 20%, again, isn't bad. It has a good long-term rate of return. You can see it had some short-term volatility to it, and some of its performance is more average in the more recent term. Its category risk, though, is average. This must be on a little bit below average as far as 0.73, but it's within the average band for its category. And this gives you some information as far as how the particular asset, in most ETFs are index funds. They're tracked against an index. So this about tells you what index it's tracking and how it's calculated and how it compares to other funds in that same category. Now, a lot of people look at performance, and again, it's important to compare fund against other funds. Now, when it comes to ETFs, there's an additional nuance, and there's something called tracking error. And because with an exchange-traded fund, you're buying it directly from other investors, there's a chance that the rate of return you get will be a little bit different than the rate of return of the portfolio itself. And so when we have rates of return for ETFs, we quote both a NAV return as well as a price return. They're both total returns, but one reflects what you would have gotten by buying or selling at the NAV end of day for that period of time versus in the NAV, versus other investors. So a slight tracking error, like over the last month, for example, the price return was 2.6 versus an NAV price change of 2.5. So you'll have a little bit of deviation, typically not much if it's an actively traded ETF. However, and there is a risk during times of market uncertainty. Last year, during March of last year, in fact, a lot of ETFs, especially I think on the fixed income side, were trading with big disparities between their NAVs and their share prices. So anytime there's market volatility, be careful about trading or buying into or selling a less liquid ETF. You will find in some cases discrepancies, and be certain to use limit orders if you do that. And again, you can look at its beta information. I prefer to look at information personally on a year-by-year basis. It reveals a lot more information as far as how a given year compares as far as just moving information forward. Hey, Derek.
Got a couple for you, John. Just you're talking about performance. There were some questions. Jesse was asking for the risk-adjusted 3-year return of funds. Could you just talk about or explain the method used to compute
Sure.
the stated return?
Yeah, and it's an example, I guess, in overall where you can get information on risk-adjusted rates of return is provided, I want to say on, I can find that slide number in a second, right? On slide number 9. And it almost helps to look at that slide to get understanding of what we're doing. We're trying to equate the performance of a fund to a given level. And in this case, what we're trying to equate is how all equity funds have performed relative to the S&P 500. So in this case, over this period of time, over the last 3 years, the S&P 500 had a rate of return of 15% and a standard deviation of 18.5%. So as a fund, you could perhaps, if you've gotten 15% of return as a fund, but you've had more volatility than the S&P 500, you would adjust your rate of return down because you were more volatile. So we would penalize you for having more volatility. Alternatively, you could have perhaps a rate of return that's lower than that of the market, but because your volatility is lower, we actually adjust your rate of return a little bit higher and give you a benefit for that. So as an example then, in this case, let's take a look at the Vanguard Small Cap Value Fund here. It had a simple rate of return of 13.8%, but its risk was 1.42 times more volatile than that of the market. So we adjusted its 13.8 annual rate of return down to a market equivalent rate of return of 10.2. So it underperformed the market. It took on much more risk than you were rewarded for the rate of return. So with a risk-adjusted return, we're trying to, in effect, balance out everybody to have the same level of risk and adjusting up or down the 3-year average annual return to compensate for the level of risk. And if you go to this website, this page, if you go to the fund page and click on equity adjusted returns, this particular link here will give more information on this calculation. Any more questions, Derek? Did I stump you there? Sorry.
No, that was a great explanation. A couple more since I have you. Let's see. Diane is asking, does the mutual fund screener provide analysis of target year retirement funds that might be offered in a corporate 401k account?
They should. I mean, there's 24,000 funds that we have in there, and you can pick the fund family, and we do have many different classes of retirement class shares in there. So if it is being tracked by Morningstar, it should be available in there to analyze.
And then just another question from, let's see, this was from Paul. Paul was asking, does the mutual fund screener allow one to search for a specific fund?
You can. You're probably, if you want a specific fund, your best bet is simply to either go directly to the fund evaluator and type a ticker there, or to go ahead and enter a ticker symbol into the search box on our website, and the fund should be listed there, and you click on the link there. If you know specifically what fund you're going to, it probably doesn't make sense to use the fund screener. Probably makes more sense to simply go to the fund evaluation page and type the ticker there, or the ETF evaluation page, type the ticker there, or just simply go to the look at the search bar on our website and go ahead and do that. So when it comes to fund information and how we go ahead and analyze funds, again, ETFs have some additional nuances, but I like looking at year-by-year data. It gives me a sense for the consistency of the performance. In this case, I know these colors are very close. The darker color is the fund. The lighter green color is how the category is done. And you can see in a typical, over this time period, how many times the fund has outperformed its peer group, how many times it's underperformed, and how much that change was over time. So again, the big numbers, looking at a 10-year rate of return, masks a lot of this information. You get a sense for how volatile it is. This fund tracks pretty much the category pretty closely. So it is giving you a little bit of benefit, but not that much, as far as information. And you can see on a year-by-year basis, in some cases, it's 2.8% better than average. In some cases, back in 2013, it was 3.8 percentage points below the category average. I like looking at year by year. It's available for both funds and ETFs. I just find it more helpful than just looking at 3-year, 5-year, 10-year data, because you really get that year-to-year variability and how things have performed over time. What else you might want to look at? Things like portfolio statistics, the expense ratio, how it compares against other funds, and also its composition. In this case, this is a very concentrated portfolio. This particular ETF has 111 holdings, but really the top 10 holdings in the fund make up more than half of the overall value. It's a market cap weighted portfolio, very heavily skewed to the top 10 stocks in its holding. They make up half of the volatility and half of the composition of the fund. So it's not really diversified at all. And it's all equity, domestic equity, no foreign, no cash. And its beta may be 1, but it has a lot of variability from where the market is, because it only concentrates so much in just a small segment of the market of the largest companies. A little bit standard deviation, a little bit higher than average, and gives a risk index of 1.24 against all funds, a little bit below the category risk for its own category, which is in this case, I believe it's the large cap growth area. It's a team managed ETF. index fund, so not really much information there on an ETF side, and how you can contact the fund family itself, and expense ratio. So that information is available. And again, it's so important to take a look at expense ratios. And Derek, are you there, Derek? I have a question for you.
I'm definitely here, yes.
So have you heard of the rule of 72?
I have heard of the rule of 72, yes.
Okay, so if I have a 2% rate of expense or 2% rate of growth, what does that imply? Like using the rule of 72, that what, like in 36 years, it'll double, right? So
yes.
in this case, using the rule of 32, a 2% additional expense ratio versus a low expense ratio, you can almost have your terminal wealth. So expenses play an incredible role on your long-term wealth. So, I mean, it may not sound like much, 2% a year versus, imagine if you're paying a advisor, but that adds up over time. And that money doesn't really go anywhere to help you as far as reaching your dreams. So, we've discussed, and you had questions about, do the fund rates of return, are they taken into account? And where can you get more information on reported fund expense ratios? We happened to do an article on that called Understanding Mutual Fund Fees and Expenses back in the November 2020 journal. So article that I happened to write, and Charles was kind enough to reference it here. But if you want more information on what fund expense ratios are, where they can be seen, where they can be observed, it's available in that article for you. And performance benchmarks. I always, when it comes to expense ratios, I always look at those types of things. And if you go to our website, our main landing page for funds or ETFs, one of the sections we have in there is called performance benchmarks, where we give you how the particular categories are performed. You can look at all the different categories we have in there, the 50 or so categories, and you can get a sense for what's the typical expense ratio. Large cap blend happens to have a typical expense ratio of 0.90. And ETFs are actually much lower than that. So it helps to compare that against other types of funds. What kind of yield to expect? If you're looking for yield, you're probably not going to find it not on the small cap side. You're probably going to go for larger cap stocks. How much volatility is typically incurred, and what kind of rates of return you've observed for different categories and indexes. So that information, the performance benchmarks, I find that very helpful. It's available online. And where else can you go for information? The prospectus. So again, we always provide links to the websites of the fund themselves on our website. If you want to look at the prospectus, that's a good place to go. It'll give you much more in-depth information. In this case, the T. Rowe Price Target Date Fund is highlighted. And an important note here is that the Retirement Balanced Fund is not managed with a specific target date. It doesn't get more conservative over time. It just simply has a approximately 60-40 mix to its blend at all times versus the other target date funds on the T. Rowe Price side, which have kind of a glide path that take you to that point in time. So those prospectus will give you much more detailed information on how that is available to you. And that's kind of really the main points that we have. And we're going to open the floor for more questions. But as we do that, again, funds, I think, are best thought of as long-term holdings. I know some people like to use exchange-traded funds, especially sector funds for trading. But for me, I actually have a secret here. Is when I first got started investing, I opened up an IRA and I bought a fund, and I've held that fund now for over 30 years, and it's done well in its category. I invested in it once. It's grown. I have seen no reason to sell it. So again, a lot of funds, as long as they're true to their mission, as long as they do well within their category, I mean, you're typically not buying them to trade them. You're buying them because they make up a good segment of your asset allocation. Always compare fund performance against peers, and and that's an area where looking at just high performance funds without doing a peer comparison may just simply be pointing you to a sector that performed well in the past. They may not go forward. But if you compare funds within its peer group, you're going to find it much more revealing. You're going to find that funds that typically underperform their peer group, they're probably either it could be because of expenses or poor management or poor investment style or poor approach. that's the reason to sell a fund. And while some active managers outperform, it's hard to predict who will be there. The biggest factor is always trying to look for funds that are relatively low on expenses, have relatively low turnover, and are cost effective, tax efficient, and cost really do matter in the long run. So we've got a few minutes for questions. Derek, feel free to open things up.
All right, let's do that. A couple, let's see, Ted and Lawrence, they're both asking about how do you evaluate they're asking, does the evaluator use the Sharpe ratio and alpha? And similar question, can funds be compared by a Sharpe ratio?
It does not have the Sharpe ratio. The risk-adjusted return is close to that. We do not have a Sharpe ratio, but it's an idea that we'll jot down, and we'll have to talk about integrating into the program and down the line.
Yeah, no, that's a good point, John. We're always looking to our members. They have great questions like that, and we're always looking to improve our products. So we definitely will take notes and see what enhancements we can make to these tools. So they're definitely not static. We're always looking to improve them and provide our members with the best educational tools out there. Let's see. Richard has a good question. I'm very, very interested in hearing the response. If there is large demand for an ETF, are additional shares created? And if so, how is this done?
Yeah, additional shares are created. There's a process of where blocks of shares are released, and that you can redeem blocks of shares. So there is a process where basically it can grow infinitely, and it can shrink as well. And look at some of the funds recently, like the ARC funds. They've basically grown so large. That is the thing with ETFs, is they can continue to grow, which is why most of them are index funds, because in order to add or redeem shares, you have to know what's in the portfolio at all times. So there is a mechanical process for doing so. Now, some ETFs have different mechanics. Some there's different ways to organize them. Some are, even though they're under the label of ETFs, they might be ETNs. There's different ways to organize them, but there is a physical process. And I'm sure if you were to look at this is probably one where if Charles were here, he could tell you this a little better than I can. But if you simply do a ETF search in the association search bar, we'll probably have a much more detailed explanation of how that process works.
Right. And since I know you love to discuss taxes, or at least ask me questions about taxes in previous webinars, let's see. Ryan was just asking, what are the general tax implication differences between ETFs and mutual funds?
Yeah, well, they're both pass-through securities in a sense that they themselves don't pay taxes. So any taxes they occur, either income based from interest or dividend income or capital gains, need to be passed on to the shareholders. Now, that's the situation in terms of legally. What happens normally, though, is that because of the way ETF shares kind of grow and shrink, because there's a process of buying and selling assets that occur kind of behind the scenes, I've only typically come across income distributions, taxable distributions from ETFs, very minor capital gain distributions. Most of that stuff is sort of handled by buying and selling that occurs as the funds expand and contract in size. With open-ended mutual funds, however, you could very often be caught with a major tax hit, even though you've just bought in, you didn't sell your shares, but because the fund itself had some turnover and sold some old shares that it had a long-term capital gain on, you may go ahead and have to pay, and they'll do a distribution towards the typically end of year, where they'll go ahead and do a distribution of dividend, short-term capital gain, long-term capital gain shares. You then have to report that to the government. So typically speaking, ETFs are more tax efficient than open-ended funds, in my experience.
All right, very good. Let's see. In the AAII site, in categorization such as top performance and consistent performance, how often are the listed funds reevaluated against that conclusion?
Yeah, everything that we do on the mutual fund side or ETF side is updated once a month. So if it's a 3, 5, 10-year comparison, it would be as of the most recent month ending. So right now, all the data on our website is current through the end of March 31st.
All right, let's see. KG asked, does AAII have a tool to aggregate all funds, ETFs, stocks, and bonds in a portfolio to show the overall asset allocation in that portfolio?
Yes, I want to say that when it comes to stocks, funds, ETFs, if you put them into our portfolio tracker and enter in how many shares you own of that, if you are an A+ subscriber, it'll compute insights on that particular portfolio, and it'll tell you what the allocation is. I think it'll go back and it might even give you the sector breakdowns on the stocks you have. So there is that capability in our portfolio tracker.
Just going through a few more. Let's see. Here's one from Bill. Bill asked, can you put a stop loss in if you own a ETF fund?
I would say yes. I mean, it probably depends on your broker. They are traded on an exchange. I've not done that myself, but I would think you can. I can't think of why you couldn't. Derek, any thoughts on that?
I was curious. I do own some ETFs, but I've never actually. I'm actually using E-Trade. I use a couple other brokerage firm sites to do trading, and I honestly don't recall that as an option for ETFs, but it's definitely something we can look into. Let's see. We have another question here. Does the fund evaluator allow you to select the time period to compare results, as in your slide 28 showing a 10-year period?
No, it does not. That's a very good question, which is why I think I like to look at the year-by-year returns, because that's sort of a fixed period of time. I learned how the market's done. 10 years. I know we've been in a long bull market, so there was a lot of bull market performance in there, but we've had some down years as well. I like looking at year by year just for that reason. That if you have this rolling 1 year or rolling 3 year, you're always adding a month and dropping a month, and we just saw that a rolling 12-month period, we've lost a big down month, we picked up a big some big up months. So there is no way to go back in time, which is why it's very helpful to look at the year-by-year numbers.
Okay. Let's see. I think we have time for maybe 1 or 2 more. Let's see. Paul asked, on a day-to-day basis, where can one find the NAV for an ETF?
On a day-to-day basis, you can go to any website, including ours, and type in a ticker symbol. If you go to our website and go to the markets page or type a ticker symbol in the search button, it'll tell you what the NAV is. Now, again, if it's an ETF and the market is open, it'll tell you what the current traded ETF is, well, NAV is. If it's a open-ended fund, it'll tell you most open-ended funds compute their NAV daily, and then they release that information. And I'm in Chicago, so Derek's in Denver, so we all have different time zones. But I remember in Chicago, normally about 4 o'clock, probably 5 o'clock Eastern time. They basically they print their NAV, and so that NAV is then quoted for that open-ended fund for almost a 24-hour period. So what happens then when you go to buy, let's say you go to buy the next day, you go to buy or redeem shares in a open-ended fund, either directly with the fund or through your broker. I mean, you won't know until the next NAV print what the price you'll pay to actually buy your shares, or how much you'll get in terms of how many shares will be redeemed. Because in most cases with open-ended funds, you're either depositing a dollar amount or redeeming a dollar amount as opposed to share counts. So you won't know until the next NAV print how many shares you're buying and at what price until the next NAV print.
All right. And I think we'll just, we do have a lot of questions that we just couldn't get to tonight, but I think we'll just end on this one. Ken asked, does your tool provide recommendations for different funds?
We don't provide recommendations per se, but I think we provide you with the tools and education that, based upon your needs, you can go ahead and find, you know, 1, 2, 3, how many funds you think are appropriate for your needs. So I'm hoping, you know, as an educational organization, we're giving you the information you need to make an intelligent choice. And it starts with coming up with the right allocation, figuring out what kind of asset mix you need, and then you could use our tools to find out which are the best funds for you in that context. And it could be a factor of, if you may have limitations that are tied to perhaps your 401k plan or your broker, or if you want to buy ETFs, what's available to you. So there are some limitations there, but I think we have all the tools in place to really help make a choice that you could live with for a long period of time.
Well, thanks a lot, John. I'll turn it over to Ryan in a second, but thanks for stepping in at the last minute to fill in for Charles. Great presentation, very informative, and thanks again. And Ryan, over to you.
Sure. And I didn't have to twist my arm. We couldn't twist Charles to come on. So.
All right. Well, I'm coming on to thank both of our presenters tonight and talk about our upcoming webinars. And we do have some upcoming webinars to discuss. As a reminder, we do broadcast typically every Wednesday, 7:30 Central. And you can register for upcoming webinars at AAII.com/webinars. Next week, we will be featuring the Individual Investor Show, which I host. We'll be talking about new ways to view performance, promising socially responsible funds, and lessons from investing pros. Catch that next week at 7:30 Central. We will be taking a mid-season break, let's say, May 5th, so we'll be taking that week off. And then the following week on May 12th, we'll have another individual investor shows that focuses on how famous investors think. We'll go over some members' investing mistakes and setting your investing preferences as part of the wealth building process. We hope you'll join us on May 12th for that. And for all of our webinars, AAII.com/webinars contains all of our full archive of webinars and shows, both in the past and also ones you can look forward to upcoming. So with that, I'd like to thank once again Derek and John for tonight's presentation, and thank you for listening and viewing us. And with that, we wish you good health and good wealth. Good night, everybody.
Good night.
Good night.